Now, one of the adjustments that many of you learners do battle with is when you get an asset disposal and the depreciation coming into an exercise. Now, this is covered quite extensively under the asset disposal section, so you can refer to the videos there. But let's just go through this adjustment over here, or the two of them, number 4 and 5, and I'm working in question 6. First of all, you're told that a new filing cabinet costing $4,000 was purchased on the 1st of December. Now, that's quite important. The dates are very important when you're dealing with asset disposal, and was in error debited to the sundry expenses. Now, obviously, it's not an expense, it's an asset, so you'd have to take it out of your sundry expenses, and therefore, into your fixed asset note, which you're required to do, there is an addition of $4,000. Right, that's not what I really want to focus on. I want to look at the disposal. The disposal says to you an old office equipment was sold on credit for $2,000 on the 1st of December. Dates again, very important. This equipment originally cost $10,000. The accumulated depreciation was $7,600 on the 28th of February. Just take note, that's before this was sold. That was the beginning of the year. The bookkeeper has made no entry, so we've got to record the sale. The business depreciates equipment at 20% on diminishing balance method. And then says make the necessary adjustments, record the disposal, and to bring depreciation into account. Right, now there are a lot of steps associated with this. And let's just try and organize these steps into some type of order. I'm not going back to ledger accounts because you're not required to do the ledger. And if you do start doing ledger accounts, while it will help you and it can streamline, it can often waste time. So let's look at this sheet over here. And what this does is it just highlights for you the amounts that are important in this. So before we even get into the financial statement, let's look at what amounts we need. We need to know, first of all, what the cost price is of the item that we're selling. And if we look back, it very clearly told us that the original cost was 10,000 Rand. So you were given that figure. Then, what was the accumulated depreciation at the beginning of the year? And again, you were told the accumulated was 7,600 on the 28th of February, 20.7. So that was at the beginning of the year. So 7,600 was at the beginning of the year. But now you're not selling it on the 28th of February. In fact, we are selling this only on the 1st of December. So the year ended, the previous year ended 28th of February, so the new year starts on the 1st of March. So you've got March, April, May, June, July, August, September, October, November, December. But now, it doesn't include December. Be careful of that. It's the 1st of December, so we don't want December. So it's 9 months. So now we need to work out the depreciation for this year. Now, depreciation is an expense for this year, so we need to take this into account. So it's on the diminishing balance. So the asset I'm selling was, the cost was 10,000 minus 7,600, those figures that we were given there, gives me a book value at the beginning of the year of 2,400. Because remember, it's on diminishing balance now. Times 20%, and you've had it for 9 months of the year. Remember, we do not include December in this. And so the depreciation comes to 360 Rand. Now that's just showing your workings, and it's advisable to show your workings in the exam. So the depreciation for this year is 360. And the next thing I need to know is what is the total depreciation on this asset. Total depreciation from the day on which I bought it up until the day I sold. In other words, both of those figures. That was the amount up to the beginning of the year, plus the extra 9 months, and so your total depreciation comes to 796. Now this fixed asset note is focusing on the carrying value or the book value of assets. All right, so that's the important thing we want to know. The whole reason why we depreciate is to show our assets in the financial statements at a realistic figure. So although we've got the cost and the accumulated, we calculate the carrying value. And that's why it's actually in bold. You wanting to know what the carrying value was at the beginning of the year, what happened during the year, and what's the carrying value at the end. So we need to know what the carrying value is of this asset we sold. And remember, the book, or the carrying value, is the cost price minus the accumulated depreciation. And now if you're working with this, you've got those figures. The cost was 10,000. The total depreciation that has been written off is 7,960. And therefore, your book value is 2,040. That is the book value on the date you sold. And that is the figure that goes into your financial statement. So let's just stop at that point. Because we're working with carrying value in the note, I want to know what the carrying value is of the asset I sold. Not the selling price, the carrying value, because that's what I'm balancing out here to. And so the carrying value was 2,040, and so you can immediately insert that in. The selling price was given to you as 2,000 Rand, and therefore you made a loss of 40 Rand. And the loss will obviously go into your income statement or statement of comprehensive income as an expense, as a loss. Right, now that's recorded the disposal for you. But they also ask us to bring in the depreciation for the year. Now what you've got to remember, if you look back at your fixed asset note, you had an amount of equipment at the beginning of the year. Some of that has been sold and some has been kept. So this original amount is actually split into two. Now the complication in this exercise is that you were working depreciation on the diminishing balance. So while we know what the diminished balance was, we know what our asset was actually worth, the one that we sold, we need to know what the book value is of the asset that we've got left over. So if we do a table now for our depreciation as well, the old asset, the diminishing balance at the beginning of the year, and I'm stressing at the beginning of the year, was 65,000. Of that 65,000, the asset that you sold had a book value of 2,400 at the beginning of the year. And you've already worked out that once depreciation because you only had it for 9 months. So now we must take away the 2,400 because we didn't keep the whole 65,000. So that meant that I've now got 62,600 left over at the book value. That is times 20%, and I've had it for the whole year, and so that depreciation comes to 12,520. A little bit complicated because it's working with the diminished balance method. And then the new asset, remember that new equipment that they told us we had bought, which cost us 4,000 Rand. So that was 4,000. It's never been depreciated because it's just been bought. So there's no accumulated depreciation to subtract from it. It's times the 20%, but you only bought it on the 1st of December. So you've had it for December, January, February, 3 out of the 12 months. And so your depreciation here comes to 200 Rand. Learners, what is important is that you're streamlining your thoughts here. You're focusing on each asset it's telling you what to focus on over here. By showing your workings, you're also making sure that you're earning marks, because there's a lot of marks attached to this one adjustment, and so you need to show your workings over here. And so my total depreciation then, the one that I sold that I had for 9 months, the rest of it that I kept for the whole year, plus the new one, comes to 13,080. And once you've shown your workings, you can then immediately put that into your financial statement as the total depreciation. Please take note that I've used brackets for both the disposal and the depreciation because it is going to reduce the value of your equipment. And then to end off, to get the figures at the end, you want the cost price at the end of the year. Now it's the cost price. So I'm looking for cost figures. The cost of what I had at the beginning was 100,000. I had 100,000 at the beginning. But I sold an asset with a cost price. Remember, we identified it here. The cost price was 10,000. So I don't have that any longer. So minus the 10. Plus I bought another piece of equipment which cost me 4,000 Rand. Remember, the first time round that you buy it, the cost and the book value will be the same. And so that means that you've now got 94,000 left over as the cost at the end of the year. Now the accumulated depreciation is a little bit more involved. Over here, again, you start with what you had at the beginning. You've got 35,000. So we had 35,000 at the beginning of the year. We know that we wrote off an extra 13,080. So that added on to our accumulated depreciation. So plus 13,080. But, and this is where the but comes, just like you subtracted the cost price of the asset that you sold, you need to subtract the total depreciation on the asset that you've sold. The total amount of depreciation that had been written off. And that's where this table will again help you, because your total depreciation on the asset you sold is 7960. Remember, you don't have it any longer. You've sold it, so it can't be in your books at the end of the year. And so you're going to minus 7960. And that gives me then a book value, an accumulated depreciation of 40,120. Just going over it again, 35,000 that you had at the beginning of the year, plus the 13,080. But the crux, you must subtract away from it the total depreciation on the asset you sold. You subtract the cost of what you sold and you subtract the total accumulated depreciation. And then find the balance out of that, 53,880. Just the difference between the two figures. There is another way to solve this bottom bit over here. Having got the cost price, which is the same as what we've just done, what you could have done instead was to find the carrying value. And it's often a lot easier. Now, because we want the carrying value, we will start with the carrying value at the beginning, which was 65,000. Now, what has happened to the carrying value during the course of the year? Well, first of all, you bought another 4,000. And then you sold. And remember, this was the carrying value of what you sold. So you minus 2040. And then there was depreciation. And depreciation will decrease your carrying value. So minus 13,080. And if you work that out, you'll get the 53,880. And then, to find the accumulated depreciation, it's the missing figure. Cost minus accumulated gives you the carrying value. So the difference between the cost and the accumulated, the cost and the book value will give you your accumulated depreciation. So in other words, there's three figures at the end, Jay. You're going to have to calculate two. I would definitely suggest you do the cost, because that is the easiest of the ones. And then my recommendation is to do the carrying value. As long as you've got all the figures here, which you do, doing the carrying value here, and then let the accumulated depreciation come the missing figure. However, it would even be better if you can calculate all three figures as I've shown you here, and then you can use it and double check your figures. Right, learners, there is generally always an asset disposal coming into adjustments. And so you need to streamline those figures and get them sorted out in your head. And I would strongly recommend that you make for yourself a sheet like this. In an exam, don't write it out all fancy. Just write down very briefly as part of your workings all these figures, and then from there you can identify them. It just helps you to get your thoughts clear. Right, good luck with what's not an easy part of your syllabus.